The second refinance paperwork was already spread across the dining table when the coffee went cold. The house was quiet, except for the refrigerator cycling on and off, the low mechanical hum filling the space between lines of printed disclosures. It was early enough that the neighborhood hadn't started moving yet. No cars backing out, no garage doors lifting, just a stack of documents that looked almost identical to the ones signed 3 years earlier. The first refinance had felt responsible. Rates were lower, payments would shrink slightly, the closing costs would roll into the new balance. It was described as optimization, a small adjustment that signaled financial awareness, the kind of move working professionals make when they're paying attention. This second one wasn't framed as optimization, it was framed as protection. Property taxes had climbed steadily. Home insurance premiums had risen twice in 18 months. Utility bills moved higher in quiet increments. Groceries cost more, though the cart looked the same. Health insurance deductions had adjusted upward during open enrollment. None of it felt dramatic on its own. Each line item rose in isolation. Together they created a narrowing. The refinance offered space. Not freedom, not growth, space. The payment would extend again to 30 years. The amortization schedule would reset. The monthly obligation would fall just enough to offset everything else that had grown. The balance would increase slightly. The timeline would stretch quietly forward. It appeared stable. At work, income had improved over the years. Annual raises, a title change, performance bonuses that arrived inconsistently but reliably enough to be expected. The household income looked stronger on paper than it had 5 years earlier. Friends saw a promotion announcement online and responded with congratulations. Stability from the outside appeared intact. But the fixed expenses had evolved faster than the raises. Childcare had ended, replaced by after-school programs and activity fees. Car payments overlapped for a year when one vehicle needed replacement before the other was finished. The newer car came with better safety features and a longer loan term. It felt like a prudent decision at the time. Retirement contributions had increased incrementally, partly out of discipline and partly out of default escalation settings. Health savings account contributions rose as deductibles climbed. College savings accounts were opened with small, consistent deposits. Every action aligned with what responsible households were expected to do. None of it was reckless. There were no luxury purchases that triggered regret, no sudden lifestyle explosions, no dramatic career risks. Vacations were modest and spaced out. The house was not oversized for the area. The neighborhood schools were rated well, but not elite. The grocery store was mid-range. Streaming subscriptions accumulated slowly, one at a time. Stability had been maintained carefully. The refinance documents represented a continuation of that maintenance. The loan officer's email used familiar language: consolidation, flexibility, smart restructuring. The numbers showed a lower monthly payment. The total interest over the life of the loan was longer and heavier, but that line item sat further down the page. The immediate column drew more attention. The dining room remained still. The folder stayed closed for several minutes before being opened again. Years earlier, purchasing the home had marked a transition, from renter to owner, from temporary to rooted. It was the largest financial commitment ever made, and it felt like advancement. The down payment had taken years to accumulate. The mortgage approval email had felt like validation. Ownership came with predictable responsibilities: maintenance, repairs, seasonal costs. But it also carried an intangible reassurance. A fixed-rate mortgage felt like insulation from rent increases. Stability was embedded in the structure of the loan itself. Over time, that insulation thinned. Property assessments adjusted upward as the neighborhood improved. Insurance recalibrated after regional weather events. The escrow portion of the payment grew, even though the principal and interest portions stayed the same. Each year's annual escrow analysis letter arrived in the mail with neutral language and slightly higher figures. Nothing spiked, it compounded. Meanwhile, the cost of maintaining appearances within the same neighborhood subtly increased. A new roof on a nearby house, landscaping upgrades across the street, kitchen renovations posted in local social media groups. None of it created pressure directly, but it reshaped the baseline of what was visible. Maintaining perceived stability required quiet alignment. Work remained steady, but not expansive. There were no windfalls, no equity grants, no sudden exits. Career progression followed the typical corporate pattern: incremental raises, modest bonus variability, annual reviews. Income rose, but not exponentially. Health insurance premiums through the employer plan climbed in parallel. The 401k balance grew, but market fluctuations erased gains just as often as they created them. Contribution percentages were adjusted upward during good years and held steady during uncertain ones. It felt like long-term responsibility in motion. The refinance would not improve the retirement balance. It would not increase savings. It would simply reduce the monthly strain that had emerged from everywhere else. The first refinance years earlier had shortened the loan term slightly while lowering the rate. It felt efficient. This second one reversed that efficiency quietly. The term returned to 30 years. The clock reset again. The difference was subtle enough that it didn't feel like retreat. At dinner, conversations about money remained practical. School expenses, upcoming travel to visit family, the need to replace the aging HVAC system within a few years. There was no panic in those conversations, just coordination, planning around what already existed. Friends in similar professions described similar adjustments: refinancing, adjusting retirement allocations, delaying larger renovations. No one described collapse. They described recalibration. The word stability continued to circulate. Over the next few years, income continued to rise modestly. So did everything else. Health insurance deductibles expanded. Homeowners insurance recalculated again after regional claim activity increased. Vehicle insurance premiums adjusted upward without accidents. Subscription services raised prices by a few dollars at a time. The household budget spreadsheet evolved into a more detailed document. Categories multiplied. Fixed costs occupied a larger share of net income than they had earlier in the decade. Discretionary spending narrowed without being eliminated. The second refinance blended into normalcy. Payments were manageable. The sense of strain eased slightly. There was no immediate downside visible in daily life. What changed was less visible. Equity accumulation slowed. The extended amortization schedule meant more interest in earlier years and slower principal reduction. Selling the home would still produce proceeds, but not as quickly as originally projected. The house remained an asset, but the timeline for meaningful leverage lengthened. At work, younger colleagues arrived with higher starting salaries than those offered 5 years earlier. Their compensation packages reflected a tighter labor market. It did not create resentment, but it reframed the trajectory. Progress had not stalled, but it had flattened. Bonuses became more variable during economic uncertainty. Performance reviews referenced market conditions more often than growth strategies. Stability remained, but expansion became less certain. The refinance, once framed as protection, began to resemble accommodation. The monthly payment was predictable. That predictability required constant adjustment elsewhere. Vacation frequency decreased slightly. Vehicle replacement timelines stretched longer. Home improvement projects were spaced out further apart. Nothing dramatic happened. There was no foreclosure notice, no job loss, no credit crisis. The credit score remained high. Bills were paid on time. Retirement contributions continued. College savings grew gradually. The household looked stable from every measurable angle. Yet the margin for flexibility narrowed year after year. When the HVAC system eventually failed during a peak summer month, the replacement was financed over 5 years at a moderate interest rate. The cash reserves covered part of it, but not all. The financing felt reasonable given the circumstances. The monthly payment joined the others. The spreadsheet expanded again. Later, when property taxes adjusted upward after a reassessment, the escrow portion of the mortgage increased accordingly. The refinance had lowered the principal and interest portion enough that the total payment remained manageable, but the underlying upward drift continued. Perceived stability required periodic restructuring. Retirement projections showed adequate progress toward conventional benchmarks, assuming continued contributions and moderate market returns. The refinance did not derail those projections, but it shifted the expected mortgage payoff date closer to retirement age than originally planned. That realization did not arrive dramatically. It appeared while reviewing an online account summary late one evening. The payoff year was visible in small text. It was later than it once had been. The house would likely not be fully paid off before retirement unless additional principal payments were made. Those additional payments were possible in theory, but rarely practical in the monthly flow of obligations. Maintaining stability had required deferring acceleration. Colleagues discussed similar patterns over lunch: refinancing to manage rising costs, extending loan terms, prioritizing liquidity over rapid payoff. It was not framed as decline, it was framed as adaptation to broader economic shifts. Over time, adaptation became the dominant pattern. The children grew older. College tuition figures loomed closer. Contributions to 529 plans increased slightly during stronger income years and paused during tighter ones. The home continued appreciating modestly, though appreciation did not translate into usable liquidity without selling or borrowing. Borrowing remained an available option. Home equity lines were offered frequently by mail. Pre-approved credit arrived in envelopes with neutral language. None of it was urgent. All of it was accessible. The decision not to borrow further felt like restraint. The decision to refinance earlier had felt like prudence. Both existed within the same financial narrative. Years passed without crisis. Stability held. But the underlying structure had shifted from growth toward maintenance. Income increases primarily offset expense increases. Raises covered insurance adjustments. Bonuses covered larger annual costs like property taxes or home repairs. Windfalls were absorbed by existing obligations rather than expanding freedom. The refinance documents from years earlier were filed away in a cabinet. Their presence was no longer emotionally charged. They represented a moment when preserving monthly comfort took precedence over long-term acceleration. The long-term cost was not catastrophic. It was cumulative. Equity accumulated more slowly. Interest paid over time increased. The mortgage extended further into later life. Flexibility compressed slightly. Each year looked similar to the previous one, financially intact, but structurally tighter. From the outside, nothing appeared unstable. The lawn was maintained. The vehicles were reliable. The retirement accounts grew gradually. Vacations still occurred, though less frequently. Stability had been preserved. The cost of preserving it unfolded quietly across years rather than months. It did not announce itself. It did not demand attention. It appeared in recalculated payoff dates, extended loan terms, and subtle shifts in financial timelines. The perception of stability remained visible to others. The internal margin narrowed incrementally. At another early morning table years later, a new set of financial statements lay open. Not for refinancing this time, but for projecting retirement income. The mortgage balance remained present, manageable but present. The timeline extended further than originally imagined when the house was first purchased. The refrigerator hummed again in the background. Nothing had collapsed. Nothing had exploded. Every decision along the way had appeared reasonable within its context. Each adjustment had solved an immediate pressure. The long-term structure told a quieter story. Stability had been maintained carefully, deliberately, and repeatedly. It had required resets, extensions, and recalibrations. It had avoided crisis. It had avoided visible decline. And it had slowly exchanged acceleration for endurance. The papers remained on the table as the morning light shifted across the room, illuminating figures that were neither alarming nor triumphant, just extended.